Welcome to the Voice of Insurance. I'm Mark Gagan. My latest guest is someone who's just taken on a big role at a pivotal time for the reinsurance market. I spoke to Stephen Postlewhite of QBE Re about hardening rates at the mid-year renewals, capital crunches, squeezes in ILS and retro, and the long-term insurability of pandemic risk. I also asked him about what might change at QBE Re now that the former actuary and Aspen executive has taken the reins. I found someone freshly reloaded with capital and risk appetite and full of expansion plans. It was refreshing. Now, a quick apology. These lockdown-affected podcasts mean we have to do interviews however we can. This web chat sound quality leaves a lot to be desired. Stephen fades in and out a bit, well, in fact, quite a lot. But I think you can work out what he's saying. Anyway, it is what it is. Please persevere, because what he is saying is incredibly bold and frank. My first question to Stephen was to ask him what, if anything, would change under his leadership at QBE Re. Before we get started, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry.
Yes, I think what I would say, as a starting point is the business that I've taken over has been really excellently managed and very, very well underwritten. I mean, it is, above all, it has a very strong underwriting ethos behind it and technical ethos as well. And so I'm not picking up something that's broken. I'm not picking up something that needs wholesale change. However, the cycle management process that has been employed within QBE over time has meant it's shrunk quite significantly over the last. Now, I'm not saying that was the wrong strategy. I don't think it was at all, actually. And certainly I think it matched the appetite that QBE Group had for reinsurance at the time. And so I think that was done well. The next stage, though, we're looking at a very, very different marketplace now. I think there are opportunities for us to go and look at many things, actually, to try and growth outside of what we currently do. So, I mean, one of the biggest areas, I think, is truly globalizing the reinsurance business at QBE, because it kind of fits within the current operational structure, which is set out in divisions, geographical divisions. And so while there is management responsibility for a global business, you get this kind of matrix approach where you have to do a lot of things specific to each operational division. And we need to remove some of that to really introduce a kind of global view across the entire portfolio.
Is there any part of the portfolio that's missing at the moment, therefore, by implication?
I mean, we have a relatively small business within the US. We have been, I would say, more focused around London than anywhere else in the world, but we have big plays in London and Brussels. So we've got Europe and the UK, the market well served. In the US, it's been a slower strategy there, I would say, in terms of growth. And I see big potential over there in terms of what we could do in terms of growth and profitability. So, and that's about taking into new lines of business. It's about reviewing our risk appetite around CAT, about reviewing our appetite around major global clients, which we don't do a huge amount with at the moment. It's about getting the right office locations, because currently it's only New York, and I think we need to think about that. So there's lots of individual things that we need to do, but that's one that we could be doing a lot more in, I think.
QBE was early out of the blocks in terms of getting fully capitalised. It was been the first capital raise after COVID-19. Do you feel that you're really ready to go now, going into these mid-year renewals?
Absolutely, yeah. So, we have real risk appetite with the group. It's clear that going early and going relatively big in terms of making sure that the capital is in the right place puts us very much on the front foot. So I've been and will continue to be able to go and talk to our key brokers and say, we have the tools, we have, so come to us and you'll get an answer, obviously. If it's the right price and the right risk, that has put us very strongly, I would say, on the front foot, yeah.
We might as well talk straight about the mid-year renewals. Obviously, we've got Florida is presumably on your desk right now and getting quite hot. So you're very much in the market from what you're implying here, is that you've got aggregate, you've got appetite and you're ready to go. But I presume you don't want to be charging what you were charging last year.
No, that's the key thing at the moment. What price is right and what risk is right in that area. So, I mean, obviously just Burma creep, Florida companies price would be different anyway this year, given the change in risk and the AOB issues, etc. But off the back of the fact that we've got COVID-19 hurting people's balance sheets and really all sorts of issues, some of which could be quite colossal, as we know, there's a different price for risk, I think. There's a different price for putting your capital to work. And so we'll see where the market ends up with that. But I think it's a significant issue, which I think we need to respond to.
And what sort of prices are you holding out for?
That very much varies, doesn't it? It will be market driven, but we have our benchmarks that we've set around this, and we disclose exactly what they are, but it's a significant increase versus where we see things at the moment.
Yeah, certainly. I saw that the forecast is still for a very active hurricane season as well. So that, I mean, that Mother Nature's not going to go away.
Yes.
Yeah, we're talking about renewals. What is your position regarding terms and conditions at renewals? Obviously, we were talking about pricing, but what about T&C? Can you exclude pandemic risk easily from things that you could argue with a broker that there's clearly never been any intention of covering pandemic risk? What's your position? Are you clarifying exclusions where you think that there was never any intention?
We are taking a product by product, client by client approach on this. I think, it doesn't feel right to me to impose pandemic exclusion on every risk we have by any means. So, for want of a better word, we are going to underwrite the exposure to make sure that we understand it. And where there is a reasonable level of exposure, even without claims, we're going to push for a complete exclusion. But where we see little exposure, and when the client gets to their analysis on the size of that exposure, then it's another discussion point within the whole writing discussion.
On property, I mean, how worried are you about business interruption creeping into Cat XLs and things that you would never have thought they should be in there? Willis Re had their report out recently. It was the first sort of really academic work on COVID-19. They described COVID-19 business interruption as an existential threat to the entire industry. Do you agree with that? Does that really worry you?
I think it is, and I think they've correctly, but only if we see this kind of retroactive amendment of policies, in particular, I guess, in the US, but it's not isolated there. I mean, if that happens, it is certainly an existential threat, there's no doubt. There's not a lot we can do about that in some ways. We'll see what emerges over time. Yeah, outside of that, there are clear areas geographically and in terms of the underlying policies that we reinsure, which have exposure here, even without thinking that the policy is overturned legally or whatever in terms of its intent. So there are schemes, MGAs, other things like that, which do have wording which allows BI claims to be brought. I think. Now, of course, what we've seen so far is that just about every one of those still has legal issues around it of a variety of types. So I think what we're facing actually at the moment is a position where this is materially complex, and I think there's going to be a lot of legal work to do before we get to a position where we really understand the claims we're going to get, the likelihood of those claims, etc. So we're in the infancy of truly understanding all of this.
As a reinsurer, what's your gut feeling? Do you think you should just pick your cedents and then stand by them?
In the main, yeah, unless there is clear and present danger that you're just walking into a loss, which that would be foolhardy regardless of the quality of the etc. Where that's the case, if we can't get an exclusion, we'll have to come off. I think that's probably going to be the attitude that the market adopts in the main. I mean, some may be even more brutal, I guess, and just demand exclusion on just about everything. But like I say, that's our approach.
Just want to ask you about demand. There's a lot of anecdotal suggestion. We've had John Neal mentioned that London deal flow is very much, or submission flow is very much up. Is that what you're seeing? You're seeing a lot of demand. Are there new opportunities?
Yes. So yes, there certainly are. In some ways, it's an obvious perfect storm. You've got great uncertainty on what the underwriting results are going to look like for certainly the next 12 months, I would say, and significant exposure around the market. But with that, also, you have damage to the balance sheets because of asset value falls. And so really, people are in a position whereby they can either reduce their exposures because they haven't got enough capital to maintain them. They can go and raise capital, which is obviously what QBE did early. Or actually, you can pass off more risk, increases demand for reinsurance. So I'm certain that is not only happening, but will continue to gather pace. We've already seen quite an increase in submission flow, requests for quotes on new business, etc., around London, but also in the US. So clearly happening. And there's also, there's surplus relief type covers being out there too. And I think this will be a really major step up in terms of demand. Of course, in certain areas, we're going to see demand and premiums fall off. Especially some of the specialty areas, for example, some of the motor type areas where actually we have quite a big reinsurance portfolio. So I think these things will balance, but I think overall demand it can only increase. And of course, the other thing that we're seeing and being told about, I guess, is that this is going to be another trauma for third-party capital, where at the very least there's going to be a whole raft of additional crap capital. They've got issues with their own issues with their own portfolios in terms of valuations, etc. And I just see that as actually being another really big issue for retro and getting the capacity that's needed there. So companies that rely heavily on passing off to third-party capital providers, I think they're going to have to find another way. Traditional, but there'll be more demand for that, and we can see it already, in fact.
And in your position, are you much more traditional, would you say? Do you not reliant hugely on retro or third-party capital?
Yeah, so we're very much not reliant on third-party capital. Our approach has been to establish long trading relationships with a group of good business partners on the retro side. So we do have outwards retro. Yeah, but I'm sure the fact that we've had those long-term relationships won't protect us entirely from price increases at 1st of Jan. I think that's inevitable. We also write an inwards retro book ourselves, so we'll see that side too.
I was just wondering, what would be your gut feeling about, you mentioned about demand falling off, obviously in parts of the economy that have completely sort of shut down or really, really slowed down. Obviously, places you mentioned auto, but aviation, obviously, and certain parts of specialty. Yeah. What do you think your gut feeling is that whether the rate increases that you're talking about, that you feel confident, I'm sure you'll get, will they offset overall the volume that is falling off because of the economy?
Yeah, that's a very good question. My view, and there is of course a huge amount of uncertainty around this, but my view is that the increase in demand that's just going to be necessary because of injured balance sheets, together with a rate increase, will more than offset the fall in economy, if you like, or the economic demand. It's based on gut feel discussion rather than any kind of deep analysis, but I think that will at least balance and may well give rise to a bigger premium flow over the next year.
I was just going to ask you, in terms of you writing a book of inwards retro, and obviously, like everybody, you do buy some. What do you think is happening? Is the pricing going to be far more accentuated there, the pricing shift?
Yes, I think it will be. I think that's going to be the first thing to really motor. A fair amount of the Florida renewal is reliant on third-party capital sitting behind some of the big reinsurers, and so these are going to come to the fore, and they're going to come to the fore pretty quick, I think. So I think there's a real squeeze there, given also this is off the back of several years of investors not achieving any return. So it's both, if you like, trap capital and a supply, I think. And add to that many of the big retro writers, the biggest has been over the last 2 years. I just think there's going to be a major shrinkage of available capacity with more demand again because of the need to get protection because of injured balance sheets. So yeah, I think that will be the first to move, and it will move the most, actually.
Steve, I'm just thinking back to 2005 and the last time we had a real proper retro crunch. And that was the time, if you could get hold of capacity, third-party capital, it was the year of the sidecar.
Yeah.
So are you tempted at all? Do you think if you could lay your hands on capacity, given you have a good track record, you've got a good business, you've got good distribution, would 2020, 2021 be the year to get that 1 year, 2 year sidecar up and running?
I think it would be a good thing to do. There's no doubt about that. And not just for 1 or 2 years. It's a mechanism which I think has differentiated some of the reinsurers, but they're the ones at the moment that are going to be finding it problematic to actually retain their exposure. So good in principle, but I think actually trying to execute would be very, very hard at the moment, because I think we see shrinkage in well-established players' ability to find third-party capital. Anything new is going to be tough to set up. Just again.
There's not a shortage of capital. Is it just if you could promise them a return hurdle, and do you think they would suddenly appear?
Yeah, like I say, I think it's an appetite. I think after 3 years of damage and 3 years of bloody I think it's going to be very difficult to attract any significant new capital for a period of time now.
I wanted to ask you about, this is clearly a differentiation point in the marketplace. What do good reinsurers do at a time like this that not so good reinsurers don't do?
One of the biggest things is making sure that your key people are not outwards, but they maintain an outwards focus. It's very easy at times like these to get wrapped up effectively all your senior people in processes which are just trying to work out your own position. But that's one of the key things, and keep that contact up with all your clients, all your brokers, people around in the company who work with. Make sure that all continues, and if anything, be more outwards focused than you were before. I think that's a really big thing. But then I think also you've got to be brave at times like these. Things like having a blanket exclusion, that's not going to work for quite a few clients, I think. And if you're good at underwriting, you've got new clients like that coming into the market, and you're reasonably brave and assess the exposure properly, I think you can take advantage. And the other thing I think is, the maintaining of capacity, which we've spoken about already. I think that's incredibly important. So we've been put in a position very early where we know exactly what we can do. And there'll be a lot who aren't in that position and are kind of running around trying to work things out. And being quick out of the blocks there is a real plus and real advantage.
I'd like to ask you about how insurable you think pandemic disease risk is. Do you think it's the sort of thing you need public-private solutions?
I think that has to be part of the answer. It has to be, because I think when you think through the extent and scale of just happening and happened, that becomes extremely difficult to insure from an accumulation perspective. Extremely difficult. So, I think it will lead to a kind of private scenario. Absolutely. I think it will also a wholesale review of what we've done in the underlying policies to try and make sure this doesn't accumulate in quite the same way as it has in certain areas this time. But ultimately, the numbers are just too big to take in the way that you would like to give coverage up, because that accumulation is gigantic.
Obviously, you're an actuary, Steve. Before all this was kicking off, before COVID-19, the story would have been casualty and reserve deterioration and potential reserve strengthening in the marketplace. Yeah. Presumably, none of that's gone away. Is that all still happening? Do you think there's something, you mentioned also that there are new classes that you'd like to be getting into. Would you be walking towards casualty at the moment, given the rating changes?
Yes. Yeah, so the simple answer to that is yes. Pricing has moved, particularly in the US, quite substantially. And I think he's getting to and probably tipping beyond what the kind of price for the risk is. It hasn't been there probably for quite a period of time, particularly financial lines, but other areas of casualty. I do think there's a real opportunities there. We don't see ourselves as particularly exposed to prior year deterioration. We've avoided many of the areas which are seeing the worst of that. And I think this is a company that has a philosophy of run towards the fire while everybody else is running away, because that is a time when you can actually start establishing some great relationships for the future and also get a good price for the risk that you're taking on. So, yeah, in terms of having the COVID-19 going on, but also having a almost big hole in global reserves for insurance and reinsurance, I actually wonder which of those is bigger. I think Willis Re said the event is going to cost the industry 140 billion.
I think that was the worst case scenario, yes.
Yeah, but you get commentary from anywhere from 50 to 150, that kind of thing. It wouldn't surprise me at all if we see prior year deterioration over the next 5 years or so of the same sort of size.
Really?
Yeah.
Because you weren't really a big player in casualty before, would you say this is your ideal time to be running towards that fire, as you said?
As long as you've got the right tools, the right underwriters, the right way of understanding the client and the risk, absolutely.
You should be expecting news from you in that regard.
Yes, indeed.
There has been, you mentioned about the Willis Re report, and we've seen commentary coming from the Q1 commentary from executives. Some have been saying that they think that COVID-19 could be the largest loss event the insurance industry has ever seen, or if not, one of the largest. What sort of gut feeling do you have on that?
I think it will be the largest insurance event that we've ever seen. I think, even without wholesale turnover of BI wording by lawmakers, I think it's still going to be the largest insurance event we've ever seen. It affects lines of business, it affects so many areas. There's unseen exposure. There's just exposure that's very uncertain, but in casualty and FinPro lines, as we've seen, across property, through event cancellation, credit and surety type business is getting colossal numbers at times for that. It touches everything, I think, pretty much. And so that's why I think it will just add up across all those areas.
Another thing I wanted to ask is, do you think it's inevitable that we'll end up with lots of different disputes between, obviously, insurers. We're seeing insurers and insureds in dispute, things just coming to a head. Do you think that they're likely to then develop into insurer versus reinsurer disputes with things like hours clauses and all sorts of other complications?
I think that's, again, it's inevitable, because this is an event. I mean, take a cat policy. This is an event I don't think anybody ever thought would accumulate into a cat policy. One of the reasons for that is how the hours clause, for example, works, or how ex gratia payments might work if that's going on and is in certain jurisdictions. So I think there's going to be a lot of testing here of the wording of the contracts, and I think that's going to rumble on for quite some time.
And again, I presume that's a place where you as a reinsurer can differentiate yourself by being, if you stand by your client, then that is how you're going to retain that client.
Yeah, absolutely, and have a go forward position. I mean, you're not necessarily going to stand by a client and take on an guaranteed loss as the renewal comes up. That wouldn't be sensible. But in the main, being responsive to your clients, making sure that there's a big communication angle here at the moment too, isn't there? Responding quickly, working hand in glove with your client and your broker to make sure that you get as good an outcome as you can. So yeah, I think that's very important.
Great. Well, thanks very much, Steve. I wish you well in this lockdown. Hope we all come out of lockdown soon, because it'd be nice to sort of meet up face to face. But thanks very much. Keep us updated, and good luck with all upcoming renewals and everything else.
Thanks very much, Mark. Excellent.
Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.